Hey guys, welcome back. Matt here again with Keyrenter Tulsa, available always at 918-351-7000 or keyrentertulsa.com. Today we're going to be talking about how to finance a rental home for the greatest return. Of course, there are a number of things to consider when you're going to actually finance a rental property. The first thing to consider is your credit. The better your credit, obviously, the better the rates are going to be that you get from a lender. The more comfortable they feel that you have the ability to pay back that loan. If you don't have great credit, you might consider partnering with somebody that does. Taking 50% of a deal is better than taking zero of no deal or 100% of no deal. So think about partnering. Same for available cash. If you have great credit and you have a great opportunity to buy something, consider partnering with somebody to get the cash. If you have it, all the better. Consider that your investing goals might be different and might lead you down a different path. For example, if you're a cash flow investor, you might be considering one opportunity to be the better opportunity. One loan opportunity, the amount of money you're going to put down, or the interest rate, or whatever else. And if you're an appreciation player, you might consider something else. Also keep in mind that every deal is different. So if you'd like to get more specifics on the deal that you're working on, give us a shout. Give us a shout anytime at 918-351-7000, and we can run you through the pro forma of a rental property, and we can actually make it specific to the deal that you're looking at. We're going to do a case study today, and we're going to talk about what happens if you buy something that's all cash. If you buy at 50% leverage, meaning you take 50% from the bank and you put in 50% cash, 25% down, 20% down, or 15% down, and the numbers are going to change dramatically when you go through these over time. The assumptions that we use are going to be the same for every case. We're going to have a purchase price of $200,000 and rents of $1,600 a month. The assumptions are going to be that we have a 10-year hold time, and therefore the rents will be averaged out to $1,600 per month. That means that they'll be a little bit lower in year 1, but much higher in year 10. 3% annual appreciation, which is standard for our market here in Tulsa. 3% annual rent and cost inflation, which again is a fairly conservative assumption and pretty standard for our market. And then the average tax, operating costs, vacancy, etc., are all going to be the same, held constant as a proportion of our top line, of our revenue number from rent, which in this case is $1,600 a month, averaged out. So all that stuff will remain the same, and here we go. If we buy this thing for cash, what does that mean? It means we purchased $200,000, the purchase price. It means we're going to put down $200,000. The rents will be the same, $1,600 a month. We have no principal and interest payment, and we, of course, have no interest rate because we're paying all cash. If you look at the all cash purchase over a 10-year average, what you have is $1,149 of cash flow per month. You have 6.7% return on your cash from the rental income, and you have a 9% cash return after the sale. If you look at 50% down, that means we're going to take a 50% note on the property, and we're going to take 50% of our cash. We're going to pay, again, $200,000 for the property. We're going to put $100,000 down. The rents remain steady at $1,600 per month. This means that we're going to pay interest of 4.25%. Of course, you qualify for special rates if you put down a big chunk of equity or cash down into the property, and so we've done that. Now keep in mind that I'm doing this video early February of 2018, and these rates are going up. I think the prime interest rate right now is 4.5%, so this is a little bit low given where we stand, and interest rates are slated to move up still. And so if you're watching this video at some point in 2018, later in 2018 or 2019, the interest rates could be significantly higher than this. But still, for the sake of our exercise, we're going to put them at 4.25%. That means you're going to pay $492 per month in principal and interest. And held over 10 years, you're going to have almost $660 of monthly cash flow, a rental return, cash on cash return of 7.4%, and 11.9% cash return after the sale. A little bit better than if you were doing this with an all cash deal. Now, if we look at 25% down, which means you're going to put $50,000 down into the property, same purchase price of $200,000. The rents, again, are remaining constant at $1,600 per month, averaged out over 10 years. What you see now is interest rates are still the same, because as long as you're putting down more than 20% or 25%, in some cases you get preferential rates. And we're going to pay $738 per month in principal and interest. Of course, more than we did in this scenario because we have taken out a larger loan, of course. At these numbers, 25% down, you're going to see 10-year average annual returns that look like this: $411 per month of cash flow, return on your cash from rental income of 8.8%, and then return on the sale on your cash of 17.2%. The numbers are looking better. What happens if we go to 20% down? The purchase price is $200,000 still, of course. That means we're putting down $40,000 into the property and taking a note of $160,000. $1,600 rent standard, and the interest rate has gone up a little bit. You'll see you don't qualify for the low interest rate because you have less equity going into the property, and that means a little bit more risk for the lender, whoever's lending that property. Should there be a devaluation or a depreciation in the property itself, there's more risk that the loan will go bad. So you're going to be at 4.5%. Now your interest and principal payment, PI as we call it, is $787 a month. A little similar actually to what you see at 25% down, just a little bit more, and it's reflected here. This cash return on the rental income is going to be the same. You're going to have a little bit less cash flow per month, but of course you've got less money in the deal, so your cash on cash return will be the same. Cash return after sales a little bit higher. What if we go to 15% down payment? In this case, it looks like $30,000 down on the same purchase price and with the same monthly rental income. What you see here in the principal and interest category is that you're going to pay more in principal and interest because, of course, your outstanding loan amount is much more. But in addition, because there's greater risk that the lender or the bank is taking, you're going to have to pay mortgage insurance of $125. Now, this can be variable, but generally speaking, that's a fair amount to assume. And your interest rate is going to be higher because it's a lot riskier in the case that you only put 15% down, because if the property depreciates a little bit or loses value, the haircut is going to go, that could naturally take 15% out of the equity value of the property, and all of a sudden the bank has to take a haircut on their loan, which they don't like to do. So they're going to charge you more interest rate. That reflects the higher level of risk associated with that loan. What does that look like in terms of your 10-year average annual return? We're talking about cash flows just eking by $89 a month over the 10-year hold period, which means in the first couple of years of this investment, you're going to lose money, you're going to lose cash flow and have to pay money into the property every month. But over the long term, over the 10-year horizon, you're going to make some at the end, and it averages out to a small monthly cash flow amount. It means your cash return on the rental income, or the rental income of your original cash, is going to be 3%, much lower than other points that we've seen in this presentation. And then also your cash return after sales slightly lower than it was at 20%, at 16.1% here. So if we just do the comparison, what we see is that cash flow is going to steadily go down as we borrow more money, because more money is going to have to be contributed towards the principal and interest payments, and the return is going to increase slightly, but then come down a little bit on the annual cash-on-cash return from your rental. This is kind of the sweet spot, if you see here and over here, because you're paying mortgage insurance and you're paying so much in principal and interest, you're going to have very little cash-on-cash return from the rental income. So 25% or 20% down is kind of the sweet spot of where the returns really exist, and that's kind of the conventional practice when you take out a loan. That's really where most people would choose to take out money from a bank. That's a conventional side that can be sold on the secondary market, of course, and therefore you're going to get great long-term rates. You're going to lock in something for 30 years, 20 years, whatever you prefer. And those, of course, can be sold in the secondary market. The 10-year, the return on your cash at sale is going to be, again, in the sweet spot right here in 20-25% down. Some people are happier with lower cash-on-cash returns every year or month, but higher annual returns when they annualize out a return on that. Could be appreciation, could be some other stuff. But again, the 15% down is a little bit lower than other spots. particularly in our sweet spot here. So I'd encourage you to come by and have a chat with us at some point. We can run your property or your deal through the pro forma rental analysis spreadsheet that we have, and we can look at a bunch of things related to the property from the perspective of both an investor, which of course we are. We're owners here in Tulsa. We own a number of single family and multifamily properties, but also not just from the investor perspective, but also from the property manager side. We'd like to make sure that when you're doing your analysis, you're taking into account a number of expenses that may fall by the wayside when you're doing your analysis, such as vacancy rates, property management fees, unexpected maintenance, and other things that should be accounted for to make sure we're not overinflating the returns and that you would see kind of disappointed numbers in the long run in reality vis-a-vis what you projected at the beginning. Anyways, come by, have a chat with us anytime you'd like, or shoot us a mail at info@keyrentertulsa.com, or give us a shout, 918-351-7000. Until next time, thank you very much. Matt with Keyrenter Tulsa.